Welcome to this explainer. Look, today we're tackling a massive gap in the startup world. We're going to bridge that tricky space between a founder's early promise and trying to pin down a defensible, mathematical valuation. How do you actually cross that bridge? Well, you use convertible securities. If you're building or investing in the Indian startup ecosystem, you absolutely need to stick around for this because this stuff is essential.
Okay, so let's jump right into the ultimate founder's dilemma. How do you value a startup that literally has zero revenue? I mean, early on, growth is kind of just a prediction, right? If you do a formal equity round right at the start, it forces founders and investors to agree on a price that, honestly, neither side can confidently defend. It creates a ton of friction and completely stalls your early momentum.
So here's our roadmap for today. We're going to cover the valuation dilemma, the types of securities available in India, how the conversion mechanics actually work, navigating the legal side of things, and finally, the risks and a bit of a reality check.
All right, diving into part one, the valuation dilemma and how we delay that conversation.
You can think of a convertible security kind of like a financial chameleon. It starts out as debt, or maybe a hybrid instrument, and then, later on, it literally transforms into equity shares when a specific trigger event happens. This is the practical, real-world solution to that dilemma we just talked about. It lets startups take the cash today and figure out the exact price later. It protects early investors from pricing risk, and crucially, it gives founders the breathing room they desperately need to boost their metrics before stepping into a formal valuation process.
Moving on to part two, let's open up the toolbox and look at the types available in India: CCDs, CCPS, and notes.
Under Indian law, you can't just invent an instrument. You've got to pick from these three distinct options. First up, we have CCDs, or compulsorily convertible debentures. These are debt instruments that have to convert to equity. Because of that mandatory conversion rule, FEMA, the Foreign Exchange Management Act, actually treats them as equity, which makes them super favorable for foreign investors. Next are CCPS, or compulsorily convertible preference shares. These sit high up in the capital structure for things like dividends and liquidation before they convert. That makes them the absolute favorite for venture capital funds. And again, FEMA treats these as equity too. Finally, we have convertible notes. Now, here's the catch with these. Under the Companies Act, only startups officially recognized by the DPIAT can issue them. They're treated as debt until conversion and are heavily favored by domestic angel investors.
Now pause right here because this is a massive pitfall. If you're a founder who's been reading up on Y Combinator and Silicon Valley, you've definitely heard of the SAFE note, the simple agreement for future equity. But listen, Indian law does not recognize a pure SAFE as a distinct statutory instrument. You simply cannot download a US SAFE template from the internet and expect it to hold up in an Indian court or survive due diligence. No way. It absolutely must be legally adapted and translated into a compliant CCPS or convertible note structure to satisfy the Companies Act and FEMA regulations.
All right, Section 3. Let's look under the hood of the conversion mechanics, the real engine of the deal. To really understand this engine, you need to grasp the two main levers of negotiation. First is the valuation cap. This sets a maximum company valuation for calculating the investor's conversion price. Basically, if your startup skyrockets and your next round values you way above this cap, the early investor still converts as if the valuation was just at the cap. It totally protects them from runaway valuations. Then you have the discount rate. This is a percentage reduction on the share price paid by the new investors in that next round. It's a direct reward for your early believers for taking a huge risk on you when your company was, well, just an idea on a napkin.
And if you're wondering what's normal, standard market practice in Indian early-stage term sheets typically falls within a 15 to 25% discount rate. That's kind of the sweet spot. It appropriately compensates the early risk without completely punishing the founders when conversion happens.
Let's map out how this actually flows across the timeline. So, day one, the instrument is issued, cash hits the bank. Awesome. Over year one, if it's a debt-style instrument like a CCD or a note, it's usually accruing a modest interest or coupon rate just to compensate the investor for the time value of their money. Then, let's say in year two, we hit the trigger event. This is heavily negotiated, but it's typically a qualified financing round, something like a Series A that crosses a certain dollar threshold. The exact moment that trigger is hit, the engine fires up, the discount and valuation cap are applied, and boom! Right there in year two, that initial debt becomes pure equity shares.
Okay, on to Section 4, navigating the law. This is the rulebook.
When you issue one of these instruments in India, you are literally stepping into a web of intersecting laws. First, you've got the Companies Act, specifically Section 42, which governs private placements. If there's even a drop of foreign money involved, boom, you instantly trigger FEMA and RBI pricing guidelines. Though, as we mentioned earlier, the beauty here is that FEMA treats CCDs and CCPS favorably as equity, which elegantly bypasses those incredibly strict external commercial borrowing rules that usually apply to standard debt. Then there's the Income Tax Act, specifically the notorious angel tax provisions under Section 56. This means you need credible valuation reports so you aren't issuing shares above fair market value. Oh, and finally, if an alternative investment fund is investing, SEBI regulations enter the mix too.
So how do you actually execute this legally? Well, here is your actionable step-by-step checklist right from the source material. Step 1, choose the right instrument based on your DPIIT status and your investor type. Step 2, draft the term sheet and be super careful defining those triggers. Step 3, pass your board and shareholder special resolutions. Step 4, file the required forms with the registrar of companies on time. Step 5, like I said, if there is a single dollar of foreign investment, you have to report to the RBI through their FIRMS portal. And Step 6, update your statutory registers. Look, what are these securities worth to a due diligence team later if you skip these steps? Absolutely nothing. Incomplete records will 100% haunt your future fundraising efforts.
Finally, Section 5. Time for a reality check on the hidden dangers.
We really need to look at the visual impact of something called stacked dilution. Because founders don't have to agree on a valuation right away, it gets super tempting to just keep issuing convertible notes across multiple bridge rounds, note after note after note, right? But when that Series A priced round finally happens, every single one of those notes converts all at once. Suddenly, founders look at the cap table and realize the stacked convertibles ate up 35% of the company. The new Series A investors take 25%, and the founder's slice has unexpectedly shrunk down to a minority stake of 40%. It's this sneaky compounding effect that catches so many early teams completely off guard. So, to wrap up this reality check, let's run through the most common, totally avoidable mistakes. Skipping a proper valuation report, that exposes you straight to angel tax. Ignoring compounding dilution, that leads to the cap table shock we just saw. Copying foreign safes verbatim, you're just creating legally invalid instruments in India. Missing RBI reporting deadlines invites severe compounding financial penalties. And negotiating ambiguous conversion triggers practically guarantees a messy legal dispute right when you're trying to close your most important funding round. Remember, what saves you time and legal fees today can create a catastrophic due diligence nightmare tomorrow.
Which leaves us with this final thought for you to chew on. Is the speed of a convertible security worth the unpredictable cost of tomorrow's dilution? Look, these instruments are absolutely incredible tools for bridging the gap and accelerating your growth. They let you trade pricing certainty today for flexibility and speed. But that trade-off demands strategic planning and rigorous legal compliance. You have to analyze your cap table, model out those worst-case conversion scenarios, and always know exactly what you are trading away. Thanks so much for joining me on this explainer. I highly recommend you go review your own funding documents with these principles in mind.